In this chapter, we're going to learn about the GDP and the differences between real and nominal GDP. Here's real and nominal. Basically, real GDP takes into account for inflation, so it removes it. It's the better measurement to use. Nominal includes inflation. And I told you earlier in class that the price index is basically going to be used to calculate inflation rates. We're going to learn how to deal with those as well. But as we open up this chapter, we deal with this term, national accounts. And the national accounts are really what's going to keep track of all these transactions, the flow of money between all the various sectors of the economy. And if we look back at that circular flow diagram, when we go back and look at the households, the firms, the government, and the rest of the world exporting, importing, we'll see that there are really three basic markets that we're focused on. The factor markets, where you get the labor, the capital, the resources, the markets for where the goods and services are purchased, and financial markets, borrowing money, transactions of monetary investments, and so forth. Well, the household section is going to fall under the C, the consumer spending in the GDP, and that's goods and services that we purchase in a given year. And obviously our money that we use to spend on those goods and services come from typically wages, although you will find income from stocks, bonds, anything else that generates profit. And just to kind of showcase, here's an example of a stock. This is Google. It's literally ownership of a company. And they do that, they issue stocks to raise capital, to raise money to invest and expand their businesses. And it basically says that you get one share of that company. And then we also have bonds. Bonds can be done in a number of ways. We see here there are municipal bonds. The cities, the towns can issue bonds, meaning that I borrow money and I base it off of some project that I'm working on that has a value, is an asset. And you would recall that the HYCC, the town took out a bond. That's where they get evaluated with their credit rating. Housing bonds do the same thing. I want to buy a home. I'm going to issue a bond. The bank is going to loan me money to go out and purchase that home because I don't have that capital at the moment. So there's a lot of other ways that bonds operate, but basically it's borrowing money with something as a collateral typically, although you will see that there are some bonds that are issued that are unsecuritized. So when you see securitization, meaning that it's secured to something. So if you default, they're able to recoup their money in some other fashion. In addition to the bonds and stocks, there are government transfers. Government transfers are typically money that the government pays out without purchasing a good or service. So for example, Social Security would be one such type of government transfer. The government pays that money out, it does not get counted. The money that the person receives will go out and use that to purchase goods and services. That's where it will get counted. So otherwise it would basically be double counting. But government transfers refer specifically to that. Minimize that if I can. There we go. We also have disposable income. Disposable income is basically all your income that you take in, including government transfers, and then you subtract out the taxes. It's what's left over, and that's what you're able to spend on consumption and savings. And what we look at when we say private savings, it's whatever you don't spend. It's whatever money you save and put aside. That money is private savings. It's the disposable income not spent on consumption. This last part, number 8 here, is something you should pay attention to. Specifically, all of these things must equal the total flow of money. So whatever you spend in the private savings, the taxes paid should all equal the wages, the profits, interest, rent, and government transfers. And we'll see those in class later on through our formula. Transitioning, we look at the financial markets, and we're talking about government borrowing. And they borrow the money from the financial markets. So when the government wants money, they go into the financial markets and they ask for a loan. Businesses will give them loans. Banks will give them loans. It's happened over our history where we've been bailed out by banks. The government will also take in its revenue from taxes. It will go out and purchase goods and services, and that's where they buy the hammers, the computers, the employees, the military. They're spending a massive amount of money. On the other side, the international sector, we see exports and imports, and when you subtract the two, you get the net exports. It's the difference between the two. So this takes care of the government component of the equation, which, just to refresh, it's G plus C plus I plus X minus M. So keep that in mind, and we just looked at the G component. We've now seen the C component, and next we're going to look at the I component. Under this section, the business investment, what we're going to see here is that investment spending is spending on physical capital, machinery, construction, buildings, any supplies, goods that you need. And within that, you're going to get inventories. That's where Mark Broad's question about a car that was produced in 2011 but gets sold in 2012, that would fall into the inventory category that's unsold, and that's where we would account for it. And the gross domestic product is simply all those goods and services that we're looking at within that given year. One of the challenges that we'll face in this section is the intermediate goods. That's when my business goes and purchases something from another business that is needed in my production. So those are considered intermediate goods, and they get handled in a number of different ways, and typically are left out because it's the final product that we want to look at. So businesses have to be careful with their accounting to indicate whether that was sold to another business or if it was sold to an individual, because otherwise it could lead towards double counting.